Have you been tax efficient this year? The end of the financial year on the 5th of April will soon be here, meaning it's time to take a look at your plans and see what you can do to keep your tax bill low. We're going to cover some of our top tips for the upcoming financial year end and what you need to do before it arrives. With advice from the financial experts, you can start to plan ahead, safe in the knowledge that you've made the most of tax incentives before the deadline. It does mean a reduction in your tax bill, making the most of any unused reliefs brought forward or due to expire before the end of the tax year. For example, utilising the tax-free dividend allowance, utilising your personal allowance effectively, any higher rate and basic rate bands to mitigate tax as much as possible, making pension contributions, making charitable donations, and utilising your capital gains tax annual exemption. Well, the rules currently allow you to put up to a maximum of £60,000 gross into your pension each tax year. This is limited to your net relevant earnings for the tax year, but any unused pension allowance for the previous 3 tax years can be carried forward and used to make larger contributions, assuming, of course, that you have sufficient net relevant earnings to cover it in that tax year. This lets you save up to £4,000 every tax year towards your retirement, with the government adding a 25% bonus on top of what you save. So effectively, it could give you £1,000 of free cash each tax year. Also, you can earn interest on whatever you save, and because it's in an ISA, the interest is tax-free. Yes, you can. You can have as many ISAs as you like, as long as you meet the eligibility criteria for each type. However, you can only pay into one of each type of ISA in a single year. For example, one cash ISA, one lifetime ISA, one stocks and shares ISA. And you can't pay in more than your normal ISA allowance overall between those different pots. So the current ISA limit is £20,000 per tax year. Donations to charities are tax-free. So if you pay income tax, you can include the 20% income tax as gift aid. So the charity effectively gets an addition to your net donation. If you're a high rate taxpayer, you can also get an additional 20% tax relief against your tax bill. So it will be sensible to do that if you know you're going to be paying higher rates of tax and you're familiar with giving gifts to certain charities. As the gross donation extends your basic rate band, it would be sensible tax planning to make a one-off contribution to reduce any exposure to high rate tax. So the rules are you can give any amount to an individual each tax year, but this won't necessarily be immediately exempt for inheritance tax purposes. There are various gifts that can be made immediately free of inheritance tax. The first is the annual exemption. That allows you to give a total of £3,000 worth of gifts each tax year without being added to the value of your estate. It can be given to one person or split between several people. And you can carry forward this relief for 1 year only, and then it's lost. The next is a small gift allowance. You can give as many gifts of up to £250 per person as you want each tax year, as long as you have not used it against any other allowance to the same person. Gifts for weddings, there are various amounts which you can gift, which are again immediately exempt, and that will depend on your relationship to the parties. And regular gifts out of income, which is often overlooked. They're immediately exempt, but you must be able to prove that they're regular payments, you can afford to meet them after meeting your usual living costs, and they are paid out of regular monthly income and not capital. Well, that really depends on whether you have a capital gain or a capital loss, and if you can make use of any of the losses which you may have carried forward. And whether you can use your annual exempt amount or lower rates of tax depending on your taxable income. So I think it needs looking at in the round. So this was originally used to describe share transactions where shares were sold one day and bought back the following day. This was to create a disposal for capital gains tax purposes, but to regain ownership of the asset. The disposal may be made to crystallise either a loss or a gain, the loss being able to offset against other gains. So a gain could be created to use the annual exempt amount. The rules now match a disposal of shares with any acquisition in the following 30 days to avoid the tax advantages. So no, it's no longer allowed. Yes, they do. Contributing to your pension via a salary sacrifice or non-cash bonus can be very tax efficient, as the pension contributions are taken from your salary before tax is deducted, therefore reducing your taxable income. This will save both income tax and national insurance.